If more than 30% of your net worth is tied to a single stock and you're 10 years or less away from retirement, this video could save you hundreds of thousands of dollars. I'm Paul Brandwine with Playbook Wealth Partners. We work with clients with concentrated stock positions, business owners nearing an exit, and real estate professionals who are looking to no longer be landlords, exit their positions, their businesses, their real estate portfolios in a tax efficient way. So clients come to us with an appreciated stock position that they've acquired through RSUs over the years or a timely investment in the right ticker at the right time. And now their wealth is super concentrated in that one position. So what we work on is helping them decide how to diversify out of that position without sending Uncle Sam more than he's earned. This video is going to talk about those different strategies that we implement with our clients in order to help them diversify in the most tax efficient way possible. Please note, this does not constitute tax advice or investment advice. If these strategies are interesting to you, we'd love the opportunity to speak with you specifically on your position, but this video is for educational purposes. Hope you enjoy. As you approach retirement, this concentration risk becomes more and more of a potential issue. So when you're 35 and you have 50% of your net worth tied to Tesla because you're a big Elon Musk fan, you have time to recover if he sends a tweet that derails the stock and it drops by 30%. But if you're 58 and you're a Tesla employee and 35, 40, 50% of your net worth is tied to that one ticker, that's a lot of concentration risk, and you don't have a lot of time to recover if something like that happens. So as you near retirement, it becomes more and more important. The other piece is the tax situation. So because you're nearing retirement, you're probably in the peak earning years of your career. You're in a higher tax bracket, which means your capital gains tax is high, as well as you're probably looking at the net investment income tax as well, which is an additional 3.8%. So the IRS is eager for you to sell these shares so that they can collect their 23.8% capital gains. So between a rock and a hard place here of whether or not to just liquidate and pay the taxes or stay in a position of over concentration and risk the stock losing value. So now we'll get into the different strategies and talk about if you're ready to start unwinding this position, what are the steps that we can take? What are the strategies that we can implement in order to diversify in the most tax efficient way possible? That's what's coming next. One of the first strategies that we consider when looking at an appreciated stock position is looking at the different tranches. If you've accumulated RSUs over time, or you've been continually buying a stock that you've really liked and you've accumulated many shares over the years, you probably have positions that have a much lower cost basis. So what we do with this first strategy is we look at those low cost basis shares and we decide if it makes sense to donate those shares to a donor advised fund. So donor advised fund has a couple different advantages. First, you are going to avoid capital gains by donating the lowest cost basis shares. You can actually select which shares you want to donate. So we would select the shares that have the lowest cost basis. So we would negate the largest capital gains by donating those shares. The second thing that a donor advised fund is going to do is it's going to actually offset ordinary income for that tax year. So if you donate $200,000 worth of shares in 2026, you're going to offset $200,000 of ordinary income for your 2026 tax return. So it's a great way to kind of stack strategies. When we look at donating shares to a donor advised fund, we're also going to have conversations about maybe looking at a Roth conversion, because essentially now you've freed up $200,000 worth of room to take some of your IRA money and rotate that into a Roth or a tax-free strategy. So the donor advised fund is kind of step one that we look at. If you are charitably inclined, we can donate all of those shares in one fell swoop, offset or completely eliminate the capital gain, and also offset some ordinary income for that tax year. Okay, so step two, after we have donated appreciated shares into a donor advised fund. Now what we'll do is we'll take a look at the remaining shares and we will implement a protection strategy. So there's a couple different options that we have for this. The first one is going to be a collar strategy. So what that means is essentially we're going to put guardrails on the position. So we'll say, hey, we're comfortable with a 10% drawdown in this position, and we want to get as much upside as we can. So in other words, we would participate in anything from 0 down to minus 10%, and then be fully protected then past the 10% drawdown. On the upside, the cost of putting in protection is going to be a cap. So we will not be able to fully participate in any growth of the position going forward, but we will still be able to participate and capture some upside. So if it's a 10% protection on the downside, let's call it a 15 to 20% upside potential. So the reason that we want to protect that position, number one, is we don't want to be exposed if the market takes a downturn. If there's some news that comes out about our specific stock that's going to really impact the share price, especially if we're nearing retirement. It's because we can actually use this position, we can use this as an asset that we can borrow against. So if you think about like a home equity line of credit on your primary residence, you can tap into that equity and borrow against the value of your home and take the proceeds and do some cool things with it. So first, before we think about monetizing, what we want to do is we want to make sure that that's protected, because you don't want to borrow against a house that doesn't have fire insurance, right? If the house burns down, now you have no house and you have this line of credit that you've taken out. So it's really important to protect it first before you go and borrow against it. So now the monetization piece. So once we have protected our asset, now we're able to, with more confidence, borrow against that position and essentially use it as a way to have access to cash. So we're able to monetize the position to create kind of an excess of cash to really accelerate the tax loss harvesting capability. So what we're going to do for monetization is there's two options. The prepaid variable forward is an option. So if you have over $1 million in your specific position and your liquid net worth is over 5 million, the prepaid variable forward is an option for you. So what we can do is we could do the protecting, the hedging, and the monetizing all in one step. So we would implement a prepaid variable forward, protect the downside, and continue to participate in that upside. And then we would be able to essentially take out a loan for up to 80% of the value of the position. So if it's $1 million position, it means we can borrow up to $800,000 against that position that we would receive in cash. We'll take that cash and then we'll start tax loss harvesting with it. And we'll talk about that in the next section. So prepaid variable forward is kind of option A. Option B would be to take the position and borrow against it and any other assets that we have using a box spread. Now, a box spread is essentially just an option strategy that's going to provide the purchaser with a risk-free return. So usually 3.5%, 4%, somewhere around there, which means that if we sell a box spread, our total risk is only going to be 3.5% to 4% if we do it all correctly. So what we can do with a box spread is we can usually borrow up to 50% of the total account value. So if you had $1 million in one position, but $2 million total in that account, we could borrow 50% of that. So we could take out a loan essentially for $1 million. So those are the two options. And depending on the situation, depending on if we are able to do that prepaid variable forward, or if we're looking at doing just the collar strategy, some of those different lanes will open up depending on what's available given the situation. Okay, so the last piece of the puzzle is going to be the tax loss harvesting. So up to this point, everything that we've done has kind of been to free up some proceeds that we can then take and invest in something that's going to purposefully harvest losses. So the whole strategy is based on, we have this appreciated position, so we're going to owe taxes when we sell that position. So what we're trying to accomplish is we're trying to, as tax efficiently as possible, unwind the single stock position. So we've protected the position, we've borrowed against the position. Now we have the ability to really take those proceeds and invest in something that's going to harvest losses so that we can systematically liquidate and sell our shares with as little tax consequence as possible. So there's a couple different options for this. Direct indexing is going to be the main way. So what a direct index is essentially a way to invest in all of the positions in that index individually. So if you think about the S&P 500, there's several different ways to purchase the S&P 500. You can buy a mutual fund, you can buy an ETF, or you can buy a direct index that's tied to the S&P. So what a direct index does is it's going to purchase every single one of those positions inside of the index. So instead of owning one ticker, SPY, you own all 500, essentially. This is kind of how you can look at it. And so what that allows us to do is that allows us to buy and sell positions inside of the SMA when it's advantageous for us in a tax loss scenario. All these strategies build on each other. So we've protected the position, we've monetized the position, and now we're going to take those proceeds and we're going to invest in something that's going to enable us to harvest losses and create a tax asset that we're able to use to offset gains from the sale of our concentrated position. So what we're going to look at doing is purchasing a direct index SMA. So we're going to invest into 300 or 400 of the 500 companies in the S&P 500. So for this example, let's just say the S&P 500 is the index that we're going to participate in. Instead of just buying an ETF that's tied to that position, that's tied to all those holdings, we're actually going to go and we're going to purchase the individual companies that make up the S&P 500. So why would we want to do that? Instead of just buying SPY, if you want to tax loss harvest a single ETF position, the entire S&P 500 would have to be down. And if it's down 3%, you sell it, great, we have a 3% loss that we can bank. But now we have to reinvest those proceeds and we can't go back into a like investment for 30 days without triggering a wash sale. So now we have to hold in cash for 30 days and it's not efficient. So what we do is we purchase, call it 3/4 of the companies in the S&P 500, and we intentionally leave a few companies on the bench. What we're looking at then is day in, day out, all these individual positions move up and move down. You're going to let the winners continue to run, and those companies that are down, we are able to systematically sell and then reinvest into a similar company. So the example that I've heard overutilized is Pepsi and Coke. So if you are direct indexing and you've purchased Pepsi, and Pepsi's had a rough day in the market, it's down 2%. We're able to systematically sell our Pepsi position and then right away buy Coke to replace it. So your dollars invested in the index don't change, but now we've harvested that loss from that Pepsi position that now we're able to use to offset the gain from selling whatever our stock position is that we're implementing this whole strategy for. So with all of the companies in the SMA, we're doing this each day. So it happens sometimes multiple times per day. So essentially what this whole process will do is it will allow us to continue to grow. We'll see our account value grow over time because we're invested in the S&P 500. So if the S&P is up, we would hope that our direct index SMA is also going to appreciate in value. But it's going to show some paper losses under the hood. So if we've invested $1 million into a direct index SMA, after a year, the S&P is up 15%. We're up 15% in our account value, but we've got $80,000 or $100,000 worth of losses that we're able to use to offset gains from the concentrated stock position. Okay, let's bring all these together in kind of a real world scenario and talk about how that could look. A client comes to us with $2.6 million worth of Apple stock. And of those 10,000 shares that they own, 1,000 of them were purchased early on with a really low cost basis. So step one is going to be to talk to that client and discuss a donor advised fund to essentially offset the highest gains with those 1,000 shares. So $258,000 is going to be donated in shares into a donor advised fund. It's important that we don't sell the shares first, because then we would have to pay the capital gains tax. So by donating shares, we're passing the gain along to the recipient, which means we don't have to pay the capital gains tax, and we can use that $258,000 to offset ordinary income in that tax year. So a win on both sides of the coin. We negate those capital gains, and we get a write-off for the against ordinary income for that $258,000. Now, with the remaining 9,000 shares, what we're going to do is we're going to implement a collar strategy. So we're going to protect that position. And with Apple, it's pretty volatile. So let's say we can get a 10% downside protection with a 20% upside cap. So we'll implement that. And then we will monetize the position and borrow $1 million worth of proceeds we'll take from that Apple position set by selling a box spread. And then in addition, the client also has another $1 million in a taxable brokerage account that we can use. So there's $2 million that we have at our disposal to begin to tax loss harvest. So now the conversation with the client becomes, how quickly do you want to harvest losses? So because the position's protected, we have a little bit of time. We can just stay in a direct index SMA, and we can offset the gains kind of slowly over time. Or if we wanted to ramp up the tax loss harvesting, we could look at incorporating a little bit of leverage into a 130-30 strategy, in which case we'd be able to harvest a few more losses per year. So for this particular client, the embedded gain is $1.6 million. Because they're in a high tax bracket, if they were to sell that position, they would have owed $474,000 worth of taxes. Because we are implementing this strategy, we're able to unwind that position in a tax efficient way. So that's the playbook. We really look at stacking those strategies to try to exit the position in the most tax efficient way possible. And if you're nearing retirement, that that donor advised fund is a great way to totally offset those capital gains, as well as give yourself some options as far as considering a Roth conversion. If you have most of your retirement money set up in taxable accounts, looking into a Roth conversion is going to be one of the things that the most advisors should talk to you about as you approach retirement. Using your appreciated shares as a way to unlock that Roth conversion strategy is one of the first things that we would look at. So keep that in mind if you're holding low cost basis shares. Those are not necessarily the ones that you're going to want to sell. Those have the largest embedded gains, but you can donate those shares, and it does unlock some pretty cool options for you. So I hope this was a good overview of a few of these strategies that a little bit more specialized. If this is you and in your situation, you're looking for an advisor or even a second opinion, we would love the opportunity. You can check out some resources on our website, playbookwp.com, or you can use the link below to book a call. And we'd love to just talk through your position and find out if any of these strategies will work for you. But thanks for swinging by, and hopefully this was helpful for you. Take care.